There are only few funds in the mutual fund industry that can boast of a track record of 20 to 30 years. But some of these funds have underperformed in recent past. Why is this? Well, today we are joined by Nirav Karkera, who is the head of research of Fisdom, to talk more on this. Hi Nirav, welcome to the show. So Nirav, we wanted to chat with you today about some of the big old funds and why they are underperforming in the recent past.
So, Josh, that's a very interesting question because if you see, there are indeed flagship funds who have been around since over decades now, but still continue to underperform. Now, there is no such causal relationship between vintage and underperformance, but however, it has happened so that most funds with a longer duration have not been able to really perform over the past couple of years, very specifically, and I would broadly plot it in the past 3 to 4 years sort of period range, right? And that is probably, if one were to really press hard and squeeze for a reason, I feel it would boil down to the fact that these funds have been managed with a certain style, with a certain with a certain perspective for the longest period in time, but the past 3 4 years have been nothing like the decades preceding it, right? So it could also be a case where previous styles are no longer applicable in the new markets, and probably the refinement and the adaptation to newer market cycles has not quite kept pace with the way markets have evolved. And the biggest milestone that changed the course of the markets was the pandemic, right? So you will also see a clear distinction in performance post pandemic versus pre pandemic for most of these flagship funds, and clearly a K-shaped recovery for many fund houses also.
Right, sure. And can you share some examples to illustrate that point that, why in some cases the style may have not been so conducive to that market environment, or say certain sectoral weightages in terms of fund manager being overweight or underweight wouldn't have worked in certain conditions. So yeah, if you can give some examples.
Of course, I feel one of the funds that I've liked for the longest period in time, especially for the method that they employ and their investment framework, and this is also very close to the markets today because of the rally that we have seen in mid caps and small caps. I would talk about a specific mid cap fund. Franklin India Prima fund has been along for the longest period in time, right? And one of the most well managed funds for the longest period. However, in the past couple of years, if you look at it from an absolute performance standpoint, it has underperformed most of its peers, right? And I feel over here it is one of the strengths that turned out to be their weakness also, is the fact that they have been so conscious about valuations, and they are so critical about the stocks that they include within their portfolio universe, that they weren't really able to play the momentum or the growth story that was playing out over the past couple of years, right? So in a growth market, when you try and chase value, it becomes a really different and a difficult situation. It's almost as if going with a test match strategy into a T20 game. Right, the past couple of years have been T20 for of course it's a crude example, but that's how it is. And FT, especially Prima Fund, has been sticking to its gun and its roots on having a very valuation conscious approach. If you see, it missed out on the mid cap IT rally to a great extent, and the reason could be the valuations at that point did not really seem very good, of course, but they weren't in pace with the momentum. They were conscious about the valuation, they stepped out of it, but the growth continued, and where their peers continued riding the momentum, they waited out the momentum. A very similar story with industrials also going ahead through the later half of 2021, when industrials really picked up, and there were two schools of thought where one was forward looking and was justifying all the valuation leaps that had happened in industrial. On the other, in the other school, there was FT, where as per conventional methods, the valuations did not make a whole lot of sense, and they waited that out as well. Now, when you wait out so many bouts of momentum, and you're unable to participate in a growth story in with such agility, you tend to underperform your peers. So this is one example where you rightly highlighted that there was underperformance versus peers.
Right. I think in FT's case, they entered industrials, but they exited when they felt the moment
Correct.
the valuations ran up quite a
Correct.
bit. Uh, Another interesting segment of the market is large caps, right? Because it's been a bit difficult for large cap funds to beat their benchmark from recent past. Any example there where you think that some of the mega funds which were back then, are now not doing as well, or have at least some instances of underperformance vis-a-vis the benchmark or vis-a-vis the peers.
Yeah, so large caps have been in the limelight for multiple reasons
Yeah.
over the past couple of years, and I feel the topmost reason would be their underperformance vis-a-vis benchmark indices, right? And we have this entire debate around will large caps continue to outperform indices, large cap
Right,
indices,
right,
or is there even a case for active large cap funds any longer, relevance any longer?
right.
But I feel the last couple of quarters has put that debate to rest.
Okay.
Actively managed large cap funds are finally performing, and
Right.
it's been quite a few quarters since we haven't heard anything as much on the front of active versus passive in
Right.
context of large cap. But talking about specific examples, one, there are very limited funds that have such a vintage.
Right.
But if we were to talk about vintage in actively managed large cap funds, Aditya Birla Sun Life Frontline Equity Fund is hands down one of the most flagship products that
Right.
the industry has, which focuses on the large cap
Right.
segment, right? You cannot talk about long standing large cap funds without mentioning
Right.
ABSL Frontline Equity.
Right.
I very vividly remember this has been one of my favorite funds in this since the longest period in
Okay.
time. Almost since the time I started analyzing
Okay.
mutual funds,
Okay.
right? So, but however, it has hit a rough patch, and it's not due to underperformance in terms of strategy employed or universe selection methodology employed, but it has to do more with the mandate that the fund is
Right.
trying to follow,
Right.
right?
Right.
So the fund realized that it is at least visible as a third party that the fund realized that it needs to outperform the benchmark. And from what is visible from the outside as an analyst, what I believe, they're not trying to outperform their peers. They're trying to outperform the benchmark. They're delivering relative performance versus
Right.
benchmark.
Right.
Now, because of this, what happens is they do not, their active share is not very high.
Okay.
Okay. And, at the same time, they don't, and that implies that they don't deviate a lot
Right.
from the index weightages,
Right.
and they are very closely aligned with the index weightages.
Right.
Now, the problem with such a strategy is you miss out on creating significant performance in a couple of scenarios.
Okay.
One, wherein you don't utilize the residual 20% buffer where
Yeah.
you can go beyond large cap.
Right.
When you are unable to utilize it well to generate extra return through mid cap and small cap allocations in a market where mid and small caps are favored, right?
Right.
So that's one situation where you miss out on. The other situation where you miss out is when there's a very narrow rally
Yeah.
in the large cap segment, right? So there are only a few heavyweight stocks that are moving the indices, and without significant active share, it becomes really difficult to at least outperform your peers
Right.
with such a strategy. So this is another situation where it can't really perform as well. And if you see over the past couple of years, 2017, 18, 19, you'd see some of these things have really not worked out for the fund, right? So of course at that point in time they tried and deployed into mid caps,
Yeah.
but that was not the season for mid and small caps.
Right.
We had seen consolidation in 2018,
Right.
19.
Right.
Small caps and mid caps were almost flatlining over a longer period, right? So they tried and allocated to mid caps at a wrong time, and I feel probably as course correction they decided to stick to it as a true to label large cap fund.
Right.
But they pivoted to this just before the mid and small cap rally
Right.
kicked in. So there was a sort of mistiming in terms of changing the strategy and approach. However, if someone's looking to invest in a fund that is trying to outperform the benchmark and tries to cap the risk, I feel this is good for such
Okay.
conservative players.
Sure.
But this is one of the reasons why it underperformed its peers, at least.
Right. And we also heard so much about small caps, especially in recent past. Another fund that is comes to mind is DSP Small Cap, which was earlier micro cap,
Yes.
and which even although name is now small cap, it still looks at micro cap closely. Any thoughts about that? That has also seen quite a bit of highs and lows since its launch back in the day.
So I feel, till now, like continuing the conversational flow, this is yet another respectable name that's thrown into the mix, right? So Vineet Samre managing DSP Small Cap now. It used to be DSP Micro Cap, and it used to be one of the most phenomenal plays for anyone looking at aggressive allocations. Right, and I feel that the fund's claim to fame was its ability to identify under-researched opportunities and identify plays that the larger market was not really looking at. So they've been ahead of time in most such situations. But however, over the past couple of years, you notice that the flows into small caps increased. Right, if you look at the asset sizes of small cap funds, it has ballooned it just in the past couple of years. Okay, it is like an exponential growth that we are witnessing in asset size. Now, with so much liquidity coming in and so much money being deployed into the space, the space is no longer as under researched as it used to be. One, and two, the funds are now looking beyond the small cap stocks, are going beyond Nifty 500, looking at opportunities in the micro cap space, and all such funds are being deployed there. Now, the problem with such heavy inflows into such a towards the farther end of the market is the problem of impact cost, is the problem of valuations, right? So when so much money goes in, and that is just to deploy the flows that are coming in without you giving it adequate time, and not letting the earnings really catch up to the flows that are happening, you tend to invest at slightly steep valuations also. So today, as we speak, the biggest debate in the market is what are small caps overheated? Is the valuations too rich right now? But if you look at the inflows are still consistent and still growing. Right. So now this as an environment makes it really, really difficult to identify very good picks in the small cap basket, right? So this is something that is bearing heavy on DSP small cap fund. The ability to find good bets at reasonable valuations. That's one. And two, historically, if we take a couple of steps back and look at a few months behind, or quarters even behind, you will realize that the fund is very true to its mandate. If it is trying to chase small caps and micro caps, it will be trying to play that, and it is not using the buffer to adjust for large cap allocations also. So during periods, especially let's say during the pandemic crash, right, small caps and mid caps were battered the worst, and micro caps even worse, right? But despite such a troublesome situation, the fund wasn't able to very adequately shift some of its assets to large caps that were less beaten down, right? And this has now caused quite a dent to the trailing performances, right? So when we talk about underperformance, we are also looking at trailing, which just by the way is not the only metric one should look at while talking performance. It should be discrete period performance, it should be rolling performance. But when you look at trailing in isolation, you will realize that dent is also harming it going ahead also, right? And that contributes to the underperformance narrative. However, till date, if we look at it from a pure method, process and philosophy standpoint, it remains to be one of the very well managed small cap funds. I would say it is a great fund in a rough patch at this point in time. So they will have to course correct and reassess their styles. But I'm confident and in the waiting, and just on the watch for what different are they going to do to capitalize on the cycles ahead.
So, Nirav, what's the lesson here for investors? Such large mega funds of yesteryears have also seen underperformance. These funds have, by the way, longest track records in the industry. So, when it comes to new funds, slightly new funds, how do investors like when should investors know when to exit, right? How many quarters and years of underperformance is sufficient enough, or because sometimes on the flip side, people also end up exiting in a haste.
Yes.
And equity funds generally will go through their cycles, and that's why I think the old adage is the longer the track record, the better. But your thoughts on this, please?
So, you asked a very important question, and I believe it's the perennial question on all investors' mind. When do we exit a fund? Right? I feel you should exit only in a few situations. It's very simple, and it might be slightly counterintuitive, but it is not performance based, and I'll tell you why. So, the number one reason why you should exit is if the rationale with which you invested in the fund no longer exists. So, probably you invested in it because you like the fund manager's style, right? And you now feel that style is no longer relevant. That's when you exit. You invest because you feel that a certain fund manager or a certain fund management team has exhibited significant competence in managing funds, but that team or fund manager is no longer working on that product. either within the organization or has moved out of the that is another trigger to exit. Another trigger to exit would be if the fund category or the mandate itself does not fit into your scheme of things, right?
Anymore.
Yeah. And your scheme of things could be two things, right? One, it does not fit into your personal portfolio strategy. It does not any longer align with your investment objectives, your investment goals. That is one. Or it no longer sits in your theory about the market cycle or the economic cycle that you're trying to play out. So that's when you move out of it. So let's say this is more applicable to sectoral thematic sorts of funds, right? And it could also apply to more broader mandates like large caps, right? So we know that today, there's a lot of question around small cap, mid cap valuations. There are talks, and there's a strong belief that valuations on the large cap side is good. So for those managing their satellite portfolio and willing to give a tactical allocation to large caps, uh, can potentially exit a small cap or mid cap fund that they feel no longer serves their purpose, right? So these couple of reasons together build a very solid case to exit a fund, and none of this is due to underperformance. So underperformance is a symptom, okay, that needs to be diagnosed, and you need to see why is the underperformance, and that will lead you to the answer whether to continue with a fund or exit. Mere underperformance for a period without diagnosing the underlying cause will not lead to correct results, right? So if there is underperformance because it is not correctly positioned in the cycle, but you believe the cycle in favor will start in a couple of quarters from now, it's all right. You can still stay in there, right? If you feel the underperformance is because the fund manager has changed, then you know that you will have to exit, because if you're not seeing the fund manager come back soon and take reins, that builds a solid case for exiting. Right. So these are a few reasons that I believe builds a case for an exit.
Thank you, Nirav, for joining us today and sharing all those insights. If you would like to listen to more such conversations, do subscribe to our YouTube channel and hit that bell icon.